Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a minute here to go live on all the different platforms. Today, we're going to be talking about how to analyze the internal rate of return. So, Jose will take us through that here momentarily. Go ahead and drop a comment there in the chat. Drop any questions you have in the chat as he goes through the presentation here. And it looks like we are live and up and running on all the different platforms. So we will go ahead and get it started. We're going to take the chat off the screen, but go ahead and drop some comments there in the chat. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. This is our loan officer training series that we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern. Tonight, we're going to be talking about how to analyze the internal rate of return. So Jose has a presentation ready for us. I'll go ahead and let him take it from here.
Good evening, everybody. Thank you for joining us for tonight's training. Now, at the Mortgage Calculator, as you all know, we are very investor intensive, right? We lend on all types of products, right? Agency, non QM, primary, second homes, investment properties, but we really love our investment property investors. And as you all know, at the Mortgage Calculator, we're also all about adding value to the transaction as mortgage loan officers. We're not just application takers here. That's why we love dealing with the investors, and the investors love dealing with us, right? Because we know how to break it down for them. We're in their investment property analysis, right? That's very important to add value in that manner because investors are very picky who they work with. So they definitely want to feel that they're working with an MLO who they can feel as a member of their investment team. And definitely knowing or assisting in investment property analysis is a great way to add value to the transaction. That's why tonight's training is on, and I added a little twist to the title here: how to analyze real estate internal rate of return and return on investment. They're very similar, but they're not the same thing. And let's break it down. So, what are we talking about when we say, internal rate of return? It's very specific. The internal rate of return identifies the annual growth rate of an investment. And this is the important part where it differentiates from return on investment, right? Taking into consideration the net present value of the funds invested, right? Because what could you have done with that money if it's going to take you 3 years or 4 years, for example? It could be the term on your investment. You definitely need to know what's the net present value of the funds, and then what would that money be worth on its own in 3 or 4 years, whatever would be the term of your investment, right? Because then you're going to see the future value of the money, and then the value of the money after you invest it, and hopefully the value of the money after you invest it is greater than the future value of that money would you have not done anything with it, right? So that's the key, because the internal rate of return increases over time as the cash flow generated by the business increases and is divided by the set expenses and initial investment, right? And that's the other difference there, because as the business generates cash flow, that's the money left over after all your expenses and stuff other than mortgage. Uh, as it increases, then that amount is also put into the mix to determine your internal rate of return. And I'll explain that a little bit more in the slides to come. Now, the return on investment indicates the total growth of the investment. And for real estate, it's most commonly analyzed on an annual basis. Most of you will probably not use internal rate of return. Most for real estate, most of you will probably use the return on investment. And why? Well, it's more commonly used because it is a simpler way of determining the profit of the investment without adding the net present value of money consideration that the internal rate of return utilizes. And I'm going to shed a little bit more light here on that in the next three slides. So here I have a segment here, and on the next slide I have the next part of it. I had to break this up into two slides because this is a rental property cash flow analysis template. Now these are available. There's many online calculators for this. This is just one that I happened to choose because it was pretty easy to use. Now, first thing you need to do is you need to determine the net operating income and the cash flow, right? So first, you start with determining what is the gross monthly operating income. And to determine that, as you can see in the first section up on the top, we have 3 units for this property, average monthly rent per unit, total rental income for the 3 units per month. Then we have a vacancy factor, and we have a gross monthly operating income. So it's average rent per unit, in this case 250 a night times 30 nights times the number of units, and then after considering our 25% vacancy factor, we are at $16,875 as gross monthly operating income. Right? So then after that, we need to determine the monthly operating fixed and variable expenses, right? Those can be obtained from the property information. You're looking at stuff like property management fees, repairs and maintenance, real estate taxes. And remember, these are all broken down onto a monthly basis. So you may have the annual figure for some of these, like taxes and insurance, and you're just going to divide by 12. So, homeowners or property association fees, if applicable, what is being put into replacement reserve for future expenditures, what are the utilities, and any other monthly operating expenses for the unit. So then you get your total there of your monthly operating fixed and variable expenses. And then you have to determine the annual net operating income. So for that, you would get your gross monthly operating income, which we've already determined. It's right here, this section right here, the gross monthly operating income, minus the monthly operating expenses, and that will give you your annual net operating income. So we have that figure right here, the $149,596.04. Then next we would calculate the cap rate, and the cap rate is calculated by dividing the net operating income figure, this 149,596.04, by the property value to give you a cap rate. In this case, we have a cap rate of 11.51. And then we have here to finish our calculations now. Uh, Now we're still working on our ROI, because ROI, return on investment, is basically your cash on cash return. That's where we're trying to get to the cash flow, right? So we've determined here the net operating income, but that's not our cash flow because I mean it's our cash flow if the property is free and clear, doesn't have a loan on it. So in this case, now we have to come up with our annual debt service amount. So we have our down payment here, we have our loan amount, we have our acquisition costs and loan fees when the property was purchased, the length of the mortgage, and the annual interest rate. So in this case, the initial investment total was 202,485, and then that is our down payment plus our acquisition costs and loan fees that you see right there. So 202,485. Our monthly mortgage payment 7725.73. Out of that, we have $82,523.22 is interest, and $10,185.49 is principal. So our total annual debt service is $92,708.71. So then what you do there is, and let me back up to the other slide, you get the annual net operating income 149,596.04, and you subtract the total annual debt service of 92,708.71 to arrive at our annual cash flow before taxes of $56,887.33. And then on a monthly basis, it's $4,740.61. So basically, once we have our cash flow, then the cash on cash return is basically dividing the annual cash flow, 56,887.33, by the initial investment of 202,485 to arrive at your return on investment of 28.09%. So now regarding the internal rate of return, right, because that was ROI, and the internal rate of return is a very complicated formula because you're looking at net present value of the money. You also have to take into consideration other factors like the term of the investment, right? Because the initial investment will be spread out over time. That allows more cash flow to be considered into the equation. So it could be a moving target if the term of the investment is fluid, right? So that's why it's really better really just to grab the online calculator, put the information in there, and just click calculate. Oh. Now, as I was saying, if the investment will be sold, that's another thing that you have to take into consideration, because then the profit from the sale will also need to be included. That profit figure may not be clear when you're initially investing, right? You're investing now, you expect the investment to have a term of 3 years or 4 years, but you don't really know what the investment will sell for after 3 or 4 years. I mean, you can estimate it, so you'll have an estimated internal rate of return, but is that a realistic figure? Really depends, especially with real estate, right? I mean, property values go up, property values go down. Again, that's why investors tend to like more the return on investment rather than the internal rate of return. Now, the main thing the internal rate of return is good for, that it's a good method to calculate how long it will take to recover the initial investment when you take into consideration the net present value of the money. Because as I was stating earlier, if you have that money available to you now, I mean, is it better just to put it in some interest bearing instrument, or is it better to put it into wherever you're going to invest it, or is it better just to let it sit? I mean, a lot of considerations because of the net present value and the future value of the money. So to recap, most investors do prefer to calculate ROI instead of internal rate of return, because the ROI gives a clearer picture of the profitability of the project, whereas the internal rate of return will also take into consideration net present value of the money invested and is a better measure to determine how long it will take to recover the investment, as well as the rate of return, taking into consideration the net present value of the funds invested. And that's what makes it a more complicated calculation, because if you mess up on the net present value of the funds invested, you're going to throw off the whole calculation. So, the moral of the story here is I would probably concentrate, especially when you're dealing with your investors, right? I would probably concentrate on dealing more or analyzing more the return on investment rather than the internal rate of return. So you can make sure that you add value to the transaction. Don't confuse the investor and then maybe have the investor thinking that you're making stuff up, don't know what you're talking about. Maybe you're a great loan officer, but maybe you get a little bit over your head trying to talk about internal rate of return, and then next thing you know, the investor loses confidence in your credibility, and maybe you lose out on that loan, which you perfectly could have originated because you were trying to offer assistance on things of which you had no knowledge. So it's good to try to be a consultant, but we don't want to start making stuff up and then lose our credibility and not be able to close the deal, right? Lose the deal instead of close the deal. So at the Mortgage Calculator, we're all about adding value to the transaction as loan consultants, and we definitely look forward to having you all reach out to us for all of your investment property needs.
Okay, let's see here. I think there's some questions coming in that we could pull up. What do we got here? First question is, where do you get the monthly rental income data for the income?
Well, that would be based on actual property information, right? So if it's a property that you already own, you should know what it's renting for. If it's a prospective property looking to buy, well, then you could reach out to the seller to see if they have a rent roll. If you're a realtor or if you're working with a real estate agent, you could do rental market analysis and see what the rental market comps are. So, a lot of different ways to do it. We always actually, we always prefer actual data rather than market data, if it is actually available. So if the property is available, is rented, you're going to ask for a rent roll.
All right, I think we have another question here as well. The question is, can I use the same analysis to figure out whether the asking price is reflective of true to value of the property that is being marketed?
Yeah, absolutely. That's why the analysis talks about cap rate. Really, now that's really the one that a lot of investors tend to look at as well when they're trying to determine the value of a property. Depending on the market, there's going to be like a multiplier that you're going to consider. Is it three times, four times, five times, whatever it may be for that area, for that property type, right? If it's an A type property, a B type property, a C type property, but definitely that's for investment properties. It's all about the income. Sales approach, because now we're talking about appraisals and valuations. So when you are doing a valuation, you're going to have the sales approach, you're going to have the income approach, and you're going to have the reproduction approach. How much is it going to cost you to reproduce the structure and the land? So for investment properties, true investment properties, I definitely like to look at the income approach and see what the cap rate is at, and then see if that's something that suits their fancy.
Okay, I don't see any other questions, but great analysis there. Great topic here for tonight. So we appreciate everybody tuning in. And remember, we do this at 7 p.m. Eastern Time on Tuesdays, Wednesdays, and Thursdays. So we will see you all tomorrow at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator.